Hello, welcome to another episode of World of Oil Derivatives. Today we're going back to market discussion. I'm Greg Newman, the Chief Executive of Onyx Capital Group. Back in the room is the research team, Audrey, Ehsan and Vincent, or some of the research team. And yeah, let's get straight into what we're going to talk about today. Audrey, do you want to start? Just give us an overview.
We're going to go back to Just Stop Oil. Obviously, all they wanted to campaign for was no new oil and gas projects. And this week, new oil and gas projects have been announced.
Okay, cool. Vincent?
For me, it's about the gasoline market. It's been a very bullish rally as in the recent few weeks due to a lot of supply tightness, refinery outages. And in addition to the rally in Brent crude prices, gasoline has been a talk of the oil market these days. So we'll talk about that.
Nice. And Ehsan, TBD.
Yeah, TBC. I think I'm going to do it. So it's going to be quite related to the stuff that Vincent is going to be talking about, but I'm going to focus mainly on the flat price and, go through the details of like what has happened that we've seen a good rally in Brent and WTI futures. And the positioning and also the relevancy, so the relevant details of like the product strength as well. So quite related to the stuff that like Vincent is going to talk about as well.
Okay, so Audrey, then let's start with you. More on the political side, I guess, for a change for us. But
Yeah, so I think a couple of podcasts ago, probably quite early on, we were talking about Just Stop Oil and kind of how they come along with loads of problems, not solutions. But obviously the main thing that they wanted was no new oil and gas licenses to be issued by the UK. And obviously Prime Minister Rishi Sunak came out on Monday and said that they're going to issue 100 new licenses. So, there's obviously going to be people...
Well, that's a solution, right, they came up with.
Yeah, and there was the CEO of Offshore Energies UK, so we can, he's come out and said, so currently there's 283 active oil and gas fields in the North Sea. By 2030, around 180 of those will have ceased production due to like natural decline in resources. So if we don't replace those maturing oil and gas fields with new ones, basically the decline in production of oil and gas, so our energy sources, is going to decline much faster than we can actually replace it with renewable energy. So what do you do when you don't have these new, you don't have your oil and gas, but you also haven't, picked up the pace enough in renewables to meet the demand of energy? Like, where does that actually leave? Where would that leave us? I don't think anyone would really debate that we don't need to switch to renewables. And I think, everyone's been...
Yeah, I think where it leaves us is I think that some of the point is we have to import 100% of the energy, oil and gas.
Yeah, I mean, obviously another reason for doing this is energy security on the back of like everything that happened with Russia last year. Obviously the UK wants to become as independent as possible.
Yeah, I don't think it's too hard for Rishi Sunak. It's like, what is it? Economy and basically foreign affairs. It's like, well, we care more about Russia than we do the Just Stop Oil protesters.
Yeah.
So we don't want to help them out as much as we can avoid doing it. And also we want to boost the economy. We want jobs. So if we're going to have to import oil, well, then we might as well produce our own oil. So,
Yeah.
I think the argument for the carbon footprint as well is it makes sense. Like what the way that he was putting it out was, if we want to import it, or the carbon footprint that comes from like shipping, it's going to be, a lot more significant than like issuing these new licenses and like having the supply close to home.
The counter argument, I think, is if you do say we're not going to do this, then it's kind of assuming that maybe the real thing would be to say we're not going to have any oil and gas licenses and we're not going to replace the oil that we are not producing, forcing you to try and produce renewables. That I can a bit more understand, right? Because it's like we've got to figure out a way to do this, otherwise we're literally not going to have energy. But no government's going to do that, because like we saw last week, if you do roll that dice and say, no, we're actually going to ban all these gasoline vehicles, we're actually going to ban this and that, then you do get a cost of living crisis. And it's like that's much more immediate. And I think we didn't go as far as I thought we'd go. I thought we'd test the limits of people's patience. Like, do you remember at the beginning of last year when, it might have even been 2021, I'm just kind of forgetting, but do you remember the queues on queues on like retail stations?
Yeah.
That, to me, caused more of a stir than the actual cost of living crisis in terms of visibly, right? Were people like acting out. Like people were fighting at the petrol stations, being like, I can't get it. People were filling up jerry cans. They had to ban jerry cans. It was mental, and it was all caused by hype and like the media hyping it up, and like oil analysts, I guess, hyping it up. And it turned out there was no gasoline shortage. And this is what happens, right? So what I'm saying is, for whatever reason, we got high prices, and obviously it was economic hit. But what you see in the streets and people acting out badly, I don't think it really got tested. We didn't really get tested as a country. But if you keep pushing it, and not only you can't afford it, there's just no chance you'll be able to afford it, and no chance you can get the oil. It's not being imported. I think you'll see people get pretty nasty, and that whole Dark Knight, the Mirror on Society thing, like would you blow up? What was that? Remember the scene in Dark Knight? It's like that. That is the reality. I think no government wants to see you'd much rather make a decision like this than be in that scenario. But then if Labour come out and say, I don't care, it's our mandate to be all renewables and we're just going to do it, he's got a fallback of he can just import it. And I know you guys are saying, oh, it's going to be more carbon intensive with shipping, and there's always infrastructure concerns and energy security, but you're now 1 or 2 layers deep, and the average person doesn't care about that. So if you're a government, you're like, come on, that's so easy to like basically get people to ignore. So you might be talking sense, but that's not how governments work, right? So I think this is going to be easy for Keir Starmer to like basically reverse, or at least be like, well, we are going to 100% import, and we've just got to make renewables faster. But that's like getting all political now. But anyway, it is interesting. I think it's worth bringing up, because I think that the reason why it's interesting for oil markets and oil market participants is, 2 weeks ago, we were still talking about supply crunches and, OPEC cuts, and it was all like, getting pretty testy. And then suddenly we're back up to 80. Everyone seems to be content in Brent futures. And now everyone's talking almost immediately about energy transition again. And this licensing headline is a big headline. I don't think it would have been a big headline if it came out a few weeks ago. So that's interesting to me, because the attention's turned away. And why, how can that be? Because clearly people love the oil price being higher.
I'm going to bring it
in the oil market.
The other thing that came out this week as well, so everyone's like, oh, we all need this big energy transition. Did you see Goldman Sachs have basically estimated that oil demand climbed to an all-time high in July? So it was 102.8 million barrels a day in July. So the highest ever level. So there's their like 12-month Brent projection. They've still like kept that at $93 a barrel. So you have, Goldman Sachs like, okay, we actually are, and I think I've seen other analysts coming out as well all over like LinkedIn, Twitter, saying, we are actually higher, I think, in oil demand. Well, obviously if this is an all-time high, but like then 2019, so pre-pandemic. So how do you go from being at like all-time high levels of oil to, straight to green energy? Like that's a lot of energy that we're going to need to replace. And then you have the whole like people, this not on my doorstep. I don't want, wind farms on my field. I don't want a nuclear power plant near me. So it's like, everyone thinks a couple of solar panels will do the job, but then you need storage. So then it's another story. It's like, okay, great, we'll build all the solar panels, but especially in the UK, it's not sunny for 80% of the year. We don't get a whole lot of sun, so we need to be able to store the energy when we do have it. And obviously that's a whole other kettle of fish, is these batteries, and that's a whole other market, and a completely new can of worms.
You do any kind of reading, there's not going to be enough. We cannot produce enough renewables, even if we smash all the targets. That is what it is. So I think that is what governments are accepting. Like Biden came out and said, we're going to need oil for another 10 years. And he's obviously very pro renewables. So I think this is like a new way of looking at the energy transition. It's about getting to net zero rather than not producing oil. But then that is what, I've read reports, that's frustrating for people who are obviously pro climate change, because they're saying it's a new kind of denial that these majors and oil companies can have, because they say, we need oil. So anyway, this is all like a political debate. I think what's more interesting for the oil market participants, I think, is like, okay, so we've gone back to this, and there's a denial generally in renewables. So basically what you're doing is you're kicking the can down the road, and you're saying the future us will have to deal with it. And we know what's going to happen, but you can't say that. The same as can be said about OPEC, right? I was writing in a report today, their GDP has gone, the GDP forecast in 2023 from the IMF has gone down to 1.9% from 3.2, something like that. and it's all been cited on the back of cuts. So they've been responsible for the latest deep cuts, and we have gone back up to like $80 per barrel on Brent, and that seems to be where people, including OPEC, are a lot more happy. But that we're still in the middle of massively forced cuts. So just like this renewable situation, it's like, just because you don't want to talk about the realities doesn't mean the realities won't come and hit you hard at some point. So that's general. It's like we're in a denial phase now. Let's just call it like that, in oil markets and in physical oil markets. So I don't know how long that can last, but I think if history serves anything, it can last for quite some time. And of course, the idea is these cuts will be in place at least next year. So that's quite a long time. But as you said, Audrey, like in the meantime, like there's been a lot of growth in demand. We're back to all-time highs. And I think that's the justification for keeping on saying we should rise in oil prices, because even though there might be non-OPEC supply increases, even though OPEC have got to bring oil back online, the demand should outpace that. And that's completely at odds with renewable kind of mandates and all that. So it's quite an interesting time. Like, and I think you should always follow the money, right? And when people want to talk about renewables, okay, but what are prices doing? And that's kind of a bit more indicative of how people are thinking. Anyway.
I think it's always it is sort of at odds, because it's energy security versus sustainability, of course, against a renewable mandate. The thing about net zero is that the carbon countries are trying to achieve carbon neutrality, so you can produce as much oil and gas and even coal in the world as you like, as long as the carbon output is neutral, as long as you make up for it with renewable technologies, as well as, carbon negative technologies as well, for example, like CCS, as well as some a lot of other different sort of technologies that governments are trying to develop. But the thing is, because renewables are not developing quick enough, another solution is to actually reduce production in oil and gas. But clearly we've seen in the last few years, demand continues to rise. That's definitely not feasible. And of course, the upstream stakeholders are of course very happy with the most recent announcement.
Well, it's emerging market population growth as well. It's a lot of things you have to fight when you say just stop something, which I just don't think we think is likely, right? That's just basic conclusion of that. So knowing what we know about people in the industry, it's like, they can talk, and like the Conservative government have done, like there's a lot of protests, a lot of people talking, but look, we're just going to be pro-economy, and we want the jobs, and we want this energy security, as they put it. But what they're really saying is our voters don't care. So it's all politics at the end of the day.
Something like 50,000 jobs like secure on the back of this. And also, I'm just reading, this is from Offshore Energy, saying how that UK natural gas will be significantly cleaner than importing LNG from the US. So it also helped to drive that net zero greenhouse gas emissions. And I think people need to, I think we always talk about oil and oil and oil, but this is for oil and gas licensing. It's not just oil licenses. And obviously gas has definitely got to be looked at as that transition from oil to green energy, because it is so much cleaner than oil.
Yeah, but I think the argument is more like, we got to stop all the carbons and move towards some sort of other source for energy. But back to the point that you made about the LNG flows into Europe, and also the other flows into the UK continent region. This morning I was trying to figure out what does this new 100 licenses actually mean in terms of production, how much of the demand in the UK is going to be met by this new licenses. And I couldn't actually find that many things that were useful, but it would be interesting to see how this new licensings in the North Sea is going to affect the arbitrage barrels that is going to be,
that's interesting.
That was that supposed to be ending up in the UK import market, but then both gas and oil. If UK goes more towards becoming independent of the global flows, is that going to close down the arbitrage opportunities for the oil traders, or how much of an impact would this have from all the flows that comes to the UK continent from West Africa, from US, from
I've got some
all around
stats here actually.
Okay, brilliant.
Yeah, I do. So UK regulator report. So around 63% of UK gas supply currently is imported into the country. 187 MMBOE, obviously oil equivalent via pipeline. So if you go to UK produced 38% of its gas supply in 2022. So that's and then based on that, 38% was responsible for only 24% of total emissions associated with gas supply, whereas LNG from the US was responsible for 35% of the emissions, despite being only 14% of the supply.
Because of sending it over, yeah?
Exactly.
Yeah.
So it's way, way cleaner to produce it in the UK or from the North Sea.
Yes, but I think if sticking to market economics, right, like at the end of the day, people will just buy what's cheapest. And I think in answer to your question, Ehsan, it's like, well, the US... they want to export their oil, their excess oil, light sweet oil, and they want to buy sour oil. So I don't think that's going to change. So I think the important thing is Brent benchmark being settled by this crude. A better question is, are these new oil licenses sour or sweet? And I don't think we know that yet, right? Or light heavy, we don't really know that. But generally speaking, North Sea is on the lighter side. But having said that, like Johan Sverdrup is like a real blockbuster kind of new grade that's really popular. And it's a heavy sour, so that will be interesting. But I think the answer is, look, the US are a net, importer in some respects, but they have grades that they want to export. They don't want themselves, and that won't change. So they'll just need to find a home. And I think Europe will always be the home because the refiners are geared towards the light sweet. Refiners in the Eastern world are competing with the US Gulf Coast refiners for the same crude. So the outlet will always have to remain Europe. So I think it's bearish to light heavy differential again. Like we're in negative levels on the Brent Dubai. That seems like almost like a structural thing that should probably remain. Looking at the kind of physical complex. And yeah, what else is there to be said on that? I mean, it's interesting to bring it up because whenever we talk about UK production, it's like, yeah, but it's UK. Like it's nothing on the large scale of things, but it does have ramifications. I think I read somewhere someone saying it's not going to reduce the price of oil at the tank, gasoline and all that, these new licenses. And that is 100% true. There's no guarantee. It's a global pool and it's just the global markets. So the UK stopping doing something or the UK doing something, insignificant either way. It's about, I think the only thing that really gets impacted is whether or not the UK sees the tax revenue or not, because it's getting produced elsewhere.
Yeah.
And that's the end of that. I think it's pretty much all that can be said.
Definitely, yeah. Just increasing tax revenue, but then at the same time, carbon, there will be definitely more carbon emissions as well, which is the
lower or higher? No,
higher carbon emissions
if they have their own.
Yes,
so it's about carbon auditing at some point, right?
Exactly.
It'd be like, yeah, but we produce less than that country, therefore you should invest more in us, or something like that, right? That's what it probably become about.
Yeah.
And so maybe that's it's, as I was saying before, this is easy for Labour because they don't have to. I think there's, they won't be under pressure to repeal licenses, but they'll be under pressure to grant any new ones. So he gets the best of both worlds: get the jobs, get the economy boost if there is one, get more tax because Sunak's already done it. And then when he's in power, he can say no new licenses. They've already come in, and he can push the renewable narrative. But whatever, I think we should move on. So what was you want to talk about gasoline?
Speaking of gasoline, we were mentioning the energy transition before, and has been projected that in the next 30 years, oil demand could be decreasing, but that's on the back of weaker global gasoline demand because of the transition to electric vehicles. And so that would reduce gasoline demand. But as currently, right now, 2023, there's still very, very high, and gasoline has been the strongest part of the oil barrel in the last few months. So
it's definitely helped markets like sustain itself and the refinery margin sustain itself.
Yes.
I mean, later on, I'm going to make the argument that the reason that we have high flat price at the moment is because of gasoline and also heating oil. So so when it gets to me, I'm gonna expand on this more. Especially this is more US driven.
It's fascinating because we're saying all-time high production, but we're also saying, I think there was an all-time high supply, in the US, which is a proxy for demand. So if it's all-time high, the US consumption, it's gone up loads, and also we're producing loads of light sweet as an excess. And we were oversupplied for quite a lot of this year. How did we get such a big, fundamentally, how did we get such a tight gasoline market?
refinery maintenance and
refinery,
the outages and like all that.
Okay.
Yeah.
And then naphtha was like a big dog, but now it's like it's kind of being dragged up by the gasoline strength.
Sure.
So this for me, I know people will say we talked about the second half demand. We knew this was coming. It's like, yeah, okay, but it's more the gasoline versus naphtha differential that is like astronomically high, and there's usually kind of a psychological ceiling on that level that got completely blown out last year. And so now it's like kind of free to act within that range, because from a sentiment point of view, it's like, well, yeah, it could easily go up there again. But go on, you tell us what
it's
you
all
were
about the price discovery. So last year, GasNet reached 500. Previous highs was 200. This year, right now, just past $300.
Yeah.
So another fundamental reason, it's also that the stocks are at historically low levels, at least lower than the previous 5-year range, which is also weighing on sentiment. But of course, you have the refinery outages in the US as well as some in Europe as well. Interestingly, of course, the US gasoline benchmarks, the RBOB, is rising really, really high, still lower than last year, but it's approaching $3 a gallon. But what's interesting is that the product supplied, the US implied demand has been decreasing over the last few weeks, but the real strength is actually coming from Europe with the EBOB prices, because the arbitrage US versus Europe, that's going down a lot. So usually you would expect that with RBOB rising, you would have the ARB rising as well, but currently what we're seeing is actually the opposite. So because EBOB, the European gasoline benchmark prices, it's always with the liquidity pool stuff, it's usually driven as a function of US gasoline. So if US goes up, Europe should go up as well. So of course, Europe is seeing strong increases, but then there's been strong regional demand in Europe, as well as demand coming from West Africa, pulling the arbitrage barrels as well, because usually European gasoline is transported, it's been exported from the AIA into the US or towards Africa. So there's really, really strong demand for that. So what's really interesting is that bullish sentiment has been tremendous over this past summer and could yet increase even more because of the potential of the Atlantic hurricane season, especially if a hurricane.
I was going to say these levels, it's like they're pointing to like unbelievable strength. So you're saying refinery outages. It's like, this is not a new thing though.
No,
like we haven't seen these levels when there've been like destructive hurricanes, you know, like I think it can't just be put down to that. Like if you look at it, which is our specialty, right? We're looking at it flow positioning. Do you remember you guys were commenting on your reports about how you felt that, I can't remember the level, was it $20 on the EBOB? I think you were talking about on Twitter.
Yeah.
And there was all the evidence that there was a lot of profit taking.
Yeah.
And that makes sense because the market loves a psychological level, right? So we're long, we get up to 20, let's sell. Now, when you sell and you make the positioning more balanced, it's free to go up again, right? Because there's no resistance, and the market isn't heavy on buy side flows because they've sold out of them. So these flows can re-enter, and you see this spike. I mean, with the backwardation, it's probably likely that the beginning of that new rally, that's new spike, that's exactly what I'm talking about. It's hovering around, and then it has this big spike. Markets can only really do this in like thin liquidity, or at least like a low resistance market. So if there's a hell of a lot of sellers, obviously it's just not going to do that unless it's like the most unbelievable event ever, and it wasn't. So I think this is a function of, again, the psychological limit being tested, people taking profit, but then there was underlying physical strength enough for there to be buy side flows, and there's just no resistance. So at least from a positioning perspective, it was allowed to rally, if that makes sense. But the ramifications are, you know, now that naphtha has been dragged up as well, you know, light sweet crude is meant to be what's weighing on the global complex and increasingly weighing on the complex. And when you have such a tight fuel market, good gas oil you're going to talk about, and now gasoline's blowing out, the margins are looking amazing, looking fantastic. And then refiners coming back online. So it is all really bullish crude, and you have seen the underlying dated market pick up. But this is all on the back of really OPEC cuts again though, isn't it? Right?
Yeah, I think the OPEC cuts has like you mentioned before in the reports, it's they're going deeper than we could have ever imagined. But
I'm relating it to what you're saying, gasoline. You could say there was
Gasoline.
outages, so it goes up. It's like, come on though, like
there was outages, but I think the OPEC cuts, that's more of an imbalance in the sweet versus sour markets. But gasoline,
it's an overall though as well.
Overall as well, sure. But then this time, I suppose gasoline, it's fundamentals as well as a financial flows driven rally as well, because of the bullish sentiment in summer.
Yeah.
Also, with the refinery outages, the potential of hurricane season.
This happens every single year in the gasoline market.
Yeah.
Every year we talk about outages, hurricanes, summer demand.
So perhaps it's psychological.
It is psychological for sure, and it's positioning, allowing it to rise so much, right? And it's the point is that it does. If you want to talk about fundamentals, you have to talk about, at the end of the day, there's a net, not that much supply. So it was before lack of supply.
Seems like there's a bit of deja vu from last year, because outright prices are not as high as the peaks we've seen this time last year.
Yeah.
But at the same time, it's still, so because the market participants know that it has been high before, there's still, it's difficult to find like the right price. So that potentially is what has allowed the crack to rally.
Think about the actual at the pump. They're used to buying at these levels from last year. They're still at a discount to last year.
Yeah.
So there doesn't really seem to be much of a demand shift on the back of high prices, because the actual notional high price isn't that high compared to last year. That's basically what you're saying.
Yeah. So
that makes sense.
Maybe the people think, okay, it's been high before, so it's not that bad relatively. But when you look at it against historical levels, it is still super high. And then that's what we've seen in naphtha as well, as also like distillate cracks as also. So it's
not
really,
naphtha though.
Not naphtha, no. But last year naphtha was super low.
Oh, I see. Yeah. Interesting. Anything else on that?
Interesting. Yeah, I was mentioning, because of course you have global gasoline benchmarks and cracks rallying, that supporting their refinery margins. But then looking at the ARB, which has been trending downwards, the ARB has been narrowing. So that indicates that the regional, in terms of the differentials between US
that
and
does
Europe,
back up your argument about refinery outages though, because if the summer demand is there and the US refiners, I'm assuming you're talking about, aren't so much involved as they usually are, then the gasoline's still got to come from somewhere. So it's basically the oils come from Europe more so than usual, which has allowed these like really astronomical highs on EBOB. I can believe that story a bit more.
Yeah, because all of the when the rubber rallies, when RBOB rallies, that triggers a lot of ARB selling flows. Yeah, and then so with the
but they're more so because structurally they can't get enough gasoline internally. Yeah, so the price might be high, but the ARB can't be too high because they need all the oil from Europe. You see what I'm trying to say?
So yeah, the prices must. So it seems that the ARB is closing.
Yeah, the ARB being pressured makes sense if a lot of the oil is coming from Europe, like increasingly more than usual, is what I'm saying.
Yeah, so it means that there's been so much ARB selling flows that this is getting this is dragging the ARB downwards. So it's always, but also dragging EBOB up. So an answer to my question, which is how can we be so high on EBOB when it's not like we've in this absolute disastrous world when we have been even last year. But that argument makes a bit more sense to me. So it's just still about the selling and the financial flows driving. Well, no, it's. I was actually not. I was not saying that. I was saying because of such concentrated ARB selling and the US actually needing this incremental demand increase to be satisfied from Europe this time. They always got oil from Europe and Singapore, but more so this year because of their refiners being out. I can kind of believe that a bit more, assuming the ARB was like massively open before. Anyway, go around in circles with this. But Ehsan, so we can move on. What did you want to say on the back of that?
Now that we've like uncovered bits and pieces about the gasoline market and the strength around it, I'm just gonna move on to the strength in the flat price. And in my opinion, over the last 2 weeks, what we've seen. On the screen, you can see. So we're looking at the Brent futures prices, from the 17th of July onwards. We all see all these green candles slowly rising up, and that was actually quite an interesting date because I went back and looked at the data and picked out that date what was really happening across different markets. So we're looking at the RBOB chart here. And, we've got the moving averages, the 20-day moving average and the 50-day moving average. And, before the strength that came into the Brent and WTI futures, we see that this slight dissociation from those moving averages, probably a week earlier than the strength that we saw in WTI and Brent. And if we look at the heating oil versus Brent crack as well, again, very close to those dates, but like the dissociation starts from that week starting in July 17th. And, the current levels are so far away from the 20-day and 50-day moving averages. So like all the technicals essentially are pointing towards there must be a correction, or the price is not behaving technically at least. But why does this matter, and how this is going to get filtered into flat price and the strength in the market? Essentially, I believe that most of the strength that we see in Brent, it actually comes from WTI, and the reason that WTI is very, very strong is off the back of these RBOB and heating oil in the US and the strength there.
When you say on the back of it, you mean like it's people buying RBOB and heat as a flat price?
Yeah, and that is supporting the whole oil complex and pushing TI.
Which the strength is helping the sentiment and people buy WTI?
So what I would say is like that the crude strength is product driven. So that's my point.
Product driven in a sense of like sentiment though, or literally people buying flat price RBOB, flat price heating oil, dragging Brent up, WTI up.
I mean, like it could be both ways, right? So like you could look at, right, the gasoline market is really strong, heating oil market is really strong. I want to get some exposure. Yeah. The closest thing is, right, let's just like, get into like crude futures because there's like less slippage and like I don't need to worry about it.
We do forget, don't we, how big the US trading market is.
Exactly.
Like it's enormous. Huge, and when they catch like a bull or they catch like sentiment kind of unified sentiment, it's fucking powerful. Yeah. So that could be a lot to do with retail ETFs. Have you looked a bit at that?
Not in this session, but like like I looked at so with this argument that like this whole thing is like WTI driven up. I looked at like WTI versus Brent futures, and we got that on the screen as well. That right again around that week, started that week 17th of July.
It's clear.
TI Brent has been on the rally. But one thing that is quite interesting is the structure of these two curves, and that gap that was created between the two. And I looked at this like more closely down here. We're looking at the OCT23 versus OCT24 WTI Brent box, and there's a clear uptrend that we went from like around like 20 cents up to like around 50 cents, and like on a box trading basis, this is a really, really big significant move, because like the listeners should just as a reminder, like these two contracts, Brent and WTI, they're like 99% correlated in most of the time. And such move really shows a sort of dislocation between the two. And this time, WTI is in the front seat, moving everything with it. One other thing that was super interesting was when we're looking at Brent long to short ratio and WTI long to short ratio. You see, like the WTI long to short ratio is on a rise. There's a steady trend that's been going
managed
on.
Managed money
over the last 4 weeks, and marrying that with price a little bit, we have seen really clear signs that the net positioning has been on the buy side over the last, 4 weeks, and that really translated into price.
Making a really good argument that it's investor driven and retail driven. And so, where is this bullish sentiment coming in the US for the investors? It's probably on the back of the recession concept ending, right?
There is a little bit of that. There's been like a lot of headlines that has been put out there, from the OPEC cuts all the way up to like right now that the gas at the pumps is, really, really expensive, and there is the hurricane stuff.
To Vincent's point, the US, especially when it comes around August, are used to paying a lot of money for gasoline. It's like they know it's peak demand season, and it's the one time probably at the pump, if they're looking at it, they're just going to pay it. Do you see what I mean? That does help if the end user's just like, I'm just going to buy it. and they don't actually get put off by the price. That does help, right?
Yeah, exactly. And then also it's like, I think so far in the year that oil traders have not made that much money.
It's been a tough year so far.
It has been a very tough year. And now that there is a little bit of momentum on the price, it might be their last opportunity.
Bit of FOMO.
Yeah, like till the end of the year to make something out of their book.
Yeah.
So there is a little bit of that too, looking forward and looking into the future. I think at the moment, if we want to have like a good grasp of like where the flat price is going to go, we've got to really look at the prices of heating oil and gasoline, RBOB, in the US specifically. And if there is like a turn in the price or like the positioning, people are starting like taking profit.
No, it's great analysis. I think it's testing whether these guys, how long they'll stay in for.
Exactly.
The new flow has come in and
it's been building up for a while. So like,
right.
It's not like, right, this happened last week. So it's been happening for over 4 weeks now.
Yeah.
And, there might be a point that, right, we've achieved what we wanted to achieve, and there's definitely that technical stuff as well. We are so far away from the moving averages. We're so at the top of the Bollinger Bands, or the RSIs are like all pointing towards like this market is overbought. And at some point, something is going to happen for a reversal, and I think that's going to be like the key indicators if you want to like look at the flat price and have a.
And we know the US look at things very macro related as well.
Exactly.
So when people say macro markets drive oil, it's because there's traders who react to the markets based on like macro indicators in the US. So I think you're talking about S&P. A lot there, that like the rally in equity markets will certainly help, or a turn in equity markets will be negative for their sentiment. And it's a great thing to keep an eye on. And I think the only thing I would add to that is where have they been for the first half of the year? Well, the first half of the year was a lot of recession talk. And I think a lot of the US in the same vein didn't want to buy in.
It's very, very interesting that you mentioned that actually. Like there's another thing that I want to show on the screen as well. So like this is the asset manager long versus short in the US dollar index. And the most recent data is telling us that there's been like a bit of short buildup and like longs are exiting their position. Essentially what it means is like, the US dollar index could come under a little bit of pressure. And in turn, it makes sense that when that comes under pressure, you have got like higher commodity prices. So, if there's a turn here or if there's a turn there, this money needs to flow somewhere, right? And the way that it's flowing at the moment is coming out of US dollar and like going into the commodity space, or like oil or TI or whatever you want to call it. But when they want to exit, right? Again, this cycle goes around again. Like the money is just going to get displaced into.
I like when you say, cycle is a good way of putting it, because I think it will be time to like take profit for these guys to take profit once the media articles start coming out that WTI is going to 100 again, and because then it's like, okay, everyone's paying attention again, and you're kind of going to reach saturation point again.
Another liquidity,
boost,
liquidity boost.
I think what you're saying about Goldman's. Don't forget, Goldman's have a huge presence. Sorry, they're hugely influential in the US.
Yeah, and they're holding their 12-month view at 93 still.
But as in, there was there a new report? Because they came out earlier saying, we got this wrong, but now they're confident again.
Yeah, this was this week.
And that will always help. Yeah. Again,
what was it that you pointed out that like the demand is at the highest? That was from Goldman, wasn't it?
Yes, this was Sunday. Yeah.
So like they are basically saying that the demand is at peak, right? And then like, right, the market needs to be driven higher.
That's good. Interesting.
Like they don't have to like come out and say like from 93 we move it up to 100, but it's just like creating like bits and pieces.
It's funny, the US is so demand focused, right? They seem to macro forecasts, Goldman Sachs type stuff. Everything you're saying is all demand, right? Whereas Europe seems to be more driven by supply and demand forecasts. And like Vitel came out like not so long ago, it's really hard to predict supply and demand because there's just so many things changing and the cuts and blah, blah, blah. So it makes sense that Europe's been a bit uncertain. But the US have gotten loads of certainty from the demand side being a bit more interesting, and Goldman's. That's super interesting, actually.
Yeah. I think they've been the drivers of the market, to be honest. With conviction behind.
So for now, it's momentum. you think it keeps going for now?
Yeah.
Because we've got that solid momentum.
Yeah. Oh, one other thing before we end this, just quickly, I wanted to quickly show this one as well. This is like the refinery margins and the correlation between the refinery margins and those two products, EBOB crack and gas oil crack. You know, again, around that same date, we see like a really big momentum on refinery margins being massively correlated to EBOB and gas oil crack. You know, they are the main drivers of this. They are strongly positive, they've got a strongly positive correlation to the refinery margins. But again, the turning point was a week before the rally that we saw in Brent and WTI futures. So it's really interesting. A lot of tools out there to actually kind of get an idea of
that was really good. Super interesting. I think that's a great place to leave it. So thanks everyone for joining, and thanks for listeners out there. Again, a reminder, we referenced a lot of graphs this time. We got a bit of feedback that people want to see that, and that's great feedback. I think we made a bit of an effort this time. We'll continue to. So you can watch it in person or watch us live on YouTube, and please do. And tune in next week for another kind of market type podcast. Thanks.
Brilliant. Thank you.
Awesome. Thank you.